Whenever you see a company's profits just skyrocket or a stock price make a huge jump, there's this invisible framework holding it all together, the rules of accounting. They're kind of like the hidden architecture of the entire business world, and today we are going to pull back the curtain and make them visible. It's a totally fair question, right? I mean, why bother with all these complicated rules? Why can't a company just go, hey, we made a ton of money this year, and just, call it a day? Well, it turns out that without a shared set of rules, those numbers would be pretty much meaningless. Exactly. For anyone, investors, banks, even the managers inside the company, to actually trust the numbers, everyone has to be speaking the same language. Here in the US, that language is governed by a set of rules we call Generally Accepted Accounting Principles, or GAAP for short. Just think of GAAP as the grammar. It's the rule book that makes sure every company's financial story is told in a way that's accurate and, more importantly, consistent. So, to really get a handle on these rules, we're going to do something a little different. We're going to build a metaphorical house of accounting. First, we'll pour the foundation. These are the core assumptions. Then, we're going to put up the framework. That's the nuts and bolts of how you record numbers. And finally, we'll do a quality control inspection, just to make sure the whole structure is solid and trustworthy. Okay, first things first, you gotta have a solid foundation. Before a single number ever gets written down, accountants have to make a few really basic, fundamental assumptions about the business itself. I mean, this is the bedrock. Everything else is built right on top of this.
The very first assumption is that the business is its own person, financially and legally speaking. It's totally separate from its owners. What this means in the real world is you absolutely cannot mix business and personal money. Using the company credit card to buy your weekend groceries, that is a classic no-no. This principle makes sure we're only measuring the performance of the business and nothing else.
Next up, we have to assume the business is a going concern. That's a fancy way of saying we all just agree that it's going to be in business for the foreseeable future. This is a really powerful idea because it's what justifies all the long-term planning. It's the whole reason a company can buy $1 million piece of machinery and spread that cost out over, say, 10 years. The assumption is that they'll still be around to get all the value out of it.
And finally, since we're assuming the business is going to last a really long time, we need a way to check in on its progress, right? The accounting period assumption lets us slice the life of a business into these neat, consistent chunks, like months, quarters, or years. This is why we have things like quarterly earnings reports and annual financial statements. They're like regular snapshots of the company's financial health. All right, so our foundation of assumptions is poured and solid. Now it's time to actually erect the framework of our house. This part is all about the core mechanics, the specific rules that tell us how every single transaction gets measured and put on the books.
The absolute heart of the framework is something called the duality principle. It's basically Newton's third law, but for accounting. For every action, there is an equal and opposite reaction. Every single transaction has to affect at least two different accounts, which is what keeps the entire system in the state of perfect, beautiful balance. And this isn't just a guideline, it's a mathematical certainty. And the result of that perfect balance? It gives us this, the fundamental accounting equation. Assets, which is all the stuff a company owns, must always equal its liabilities, that's what it owes to others, plus its equity, which is the owner's stake in the company. This simple equation is the beating heart of all accounting, and thanks to that duality principle, it always balances. Let's see it in action. Let's say a company buys a new laptop using a loan. Okay, so on one side of the equation, its assets go up because, hey, it now owns a laptop. But at the exact same time, on the other side, its liabilities also go up because it now has a new debt, the loan for the laptop. See, both sides moved and the equation stays perfectly balanced. Simple, elegant, and really powerful.
Now, another key piece of the framework is all about timing. The accrual principle says that you record business activity when it actually happens, not necessarily when cash changes hands. So, for example, if you make a sale in January, you record that revenue in January, even if your customer doesn't pay you until March. This gives a much more accurate picture of how the company actually performed during that specific period. So our house now has a foundation and a framework. But is it a good house? Is it built to code? Would you trust it? This is where our quality control principles come in. These rules make sure that the final numbers are reliable, honest, and tell a fair story. This quote right here perfectly captures our first quality control rule, the conservatism principle. It's basically the play it safe approach to accounting. The whole idea is to be realistic and cautious and to steer way clear of being overly optimistic about the future. So here's how that works. Imagine your company has some inventory that it paid $10,000 for, but now maybe the market's changed and you know for a fact you can only sell it for $7,000. Conservatism says you have to recognize that $3,000 loss right now, immediately. You don't get to wait until you sell it. This prevents companies from pretending their assets are worth more than they really are. Next up, transparency. The full disclosure principle says that a company has to share all information that would be significant to an outsider trying to understand the business. This includes stuff that might not fit neatly on the financial statements, like, say, a huge pending lawsuit. The goal is to give a complete picture, warts and all, no hiding the important stuff.
So this leads to a pretty logical question. If you have to disclose everything, does that mean you have to detail every single minor expense? I mean, do investors in a massive corporation really care that they bought a $2 pen? Of course not. That would be insane. And luckily, accounting has a very common sense solution for this. And that solution is the materiality principle. It basically acts as a common sense filter. An item is only considered material if knowing about it could reasonably influence an investor's decision. That $2 pen? Completely immaterial. A $20 million factory fire? Oh yeah, that is absolutely material and it has to be disclosed.
So these two principles, they work together in this perfect little dance. Full disclosure says, hey, tell the whole story, while materiality chimes in with, but focus on the chapters that actually matter. And it's that balance that makes financial reports both complete and useful, without drowning you in totally trivial details.
And there you have it. Our house of accounting is officially complete. We laid a solid foundation with core assumptions, we erected the framework with the mechanics of recording, and we passed our quality inspection with principles that guarantee trust. So why do we go through all this trouble? What's the big deal? Well, because these rules are frankly what make the entire modern economy work. They build the trust that's needed for you to invest your savings into a company. They're what allow us to actually compare Apple to Google on a level playing field. They give managers reliable data to make smarter decisions, and they create that universal language of business that we were talking about from the very beginning.
And that brings us to one last thought. If you had to take one of these principles and apply it to your own life, to how you make big decisions and how you present yourself to the world, which one would you pick? Would it be conservatism, always playing it safe? Or maybe full disclosure, being a complete open book? It's kind of an interesting thing to think about.